Assalamualaikum everyone. My name is Nia Adam Hussein bin Abdul Rahman. Student ID 6221-522-5558. Today I will present the financial analysis of Padini and Bonia Corporation Berhad for the fiscal years 2024 and 2025. In this session, we will focus on financial ratio analysis, a key tool used by investors, management, and stakeholders to evaluate a company's financial health. Financial ratio allows us to measure performance in 5 core areas: liquidity, efficiency, leverage, profitability, and market performance. This analysis helps us understand how Bonia manages its resources, generates profit, and maintains stability in comparison to its competitors. We will examine ratios such as current and quick ratios for liquidity, assets and inventory turnover for efficiency, debt and debt to equity to ratios for leverage, net profit margin, return on assets, return on equity for profitability, and earning per share for market performance.
Padini Holdings is one of Malaysia's leading fashion retailers with more than 160 stores locally and presence in several international markets such as Cambodia, Bahrain, Brunei, Oman, Qatar, Thailand, and the UAE. The company focuses on affordable and trendy apparel, footwear, and accessories under brands like Vinci, C, Padini Authentics, PDI, Mickey, P&Co, and Brands Outlet. Padini vision is to be a leading fashion retailer embracing digital transformation, while its mission is to deliver value through quality fashion, rapid inventory turnover, and international expansion. Bonia, on the other hand, specializes in luxury leather goods, shoes, apparel, and accessories. It operates 539 locations worldwide, including Malaysia, Singapore, China, Taiwan, Japan, Vietnam, Thailand, and Saudi Arabia. Bonia vision is to be recognized as a global luxury lifestyle brand, while its mission is to offer desirable luxury fashion products, expand its global presence, and maintain high standard of craftsmanship.
Hi, my name is Muhammad Halif, and this slide presents the financial ratio analysis of Padini Holdings Berhad for the years 2024 and 2025. The analysis evaluates the company's liquidity, efficiency, leverage, profitability, and also shareholder performance. Starting with liquidity ratios, Padini's current ratio increased slightly from 8.38 times in 2024 into 8.51 times in 2025. This indicates that the company has a strong ability to meet its short-term obligations using its current assets. Okay, now let's look to the quick ratio. Similarly decreased slightly from 3.31 to 3.06 times, but it remains well above 1. This shows that Padini still possesses sufficient liquid assets to cover its current liabilities without relying on inventory sales. Moving on to efficiency ratios, the inventory turnover ratio declined from 8.25 to 3.06 times. This suggests that inventory is moving more slowly in 2025, which may indicate weaker sales demand or higher inventory in holding levels. Okay, now let's have a look into the total asset turnover ratio, which also decreased from 1.05 to 0.94 times, indicating that the company generated slightly less revenue from each ringgit invested in asset, reflecting lower asset utilization efficiency. However, the receivable turnover ratio remained constant at 29.62 times in both years. This demonstrates that the Padini maintained an effective collection process and also continued to recover the customer payments efficiently. Next, for leverage ratios, the debt ratio also increased from 39.25% to 42.24%. Although liabilities have increased, the ratio remains below 50%, indicating that the company's financial risk is still manageable. The debt to equity ratio rose from 0.65 to 0.73 times. Despite the increase, Padini continues to maintain a conservative capital structure, relying more on equity than debt financing. For profitability ratios, the net profit margin improved from 7.64% to 7.99%. This indicates that the company generated higher profit from its sale in 2025 compared to the previous year. The return of assets or ROA decreased slightly from 8.01% to 7.55%. This suggests that asset growth was faster than profit growth, resulting in lower return generated from total asset. The return on equity or ROE remained relatively stable at around 13%, showing that Padini continues to provide good returns to its shareholders. And for the last part, which is earning per share, increased from 14.85 cent to 15.68 cent, indicating higher earnings attributable to each ordinary share and creating greater value for investor. In conclusion, Padini demonstrates strong liquidity, stable debt management, and improved profitability. However, the decline in inventory turnover and asset turnover suggests that the management should focus on improving operational efficiency and also the asset utilization in the future.
This slide shows Bonia Corporation Berhad's financial rating for 2024 and 2025. Liquidity. The current ratio dropped from 3.92 to 2.82 and the quick ratio from 3.24 to 3.04. While slightly weaker, the company still have enough liquid assets to cover short-term obligations. Efficiency. Inventory turnover slowed from 7.26 to 6.85. Total asset turnover stayed around 0.51 and receivable turnover fell sharply from 31.06 to 19.03, indicating slower collection from customers. Leverage. Debt ratio increased slightly to 39.1%, while debt to equity remained stable at 0.64, showing moderate financial risk. Profitability and market. Net profit margin rose slightly to 11.42%. ROA decreased a little to 5.82%. ROE improved slightly to 9.57%, and EPS went up minimally from 0.224 to 0.229. Summary. Overall, Bonia maintains stable profitability and moderate leverage, but slower receivable and inventory turnover may signal liquidity challenge that management should address. That's all from me. Thank you.
So hi, my name is Arif Irfan bin Muhammad Rizal, and today I will present the trend analysis of Padini Holding Berhad and Bonia Corporation Berhad for fiscal years, that is 2024 and 2025. So the analysis covers key financial ratios including liquidity, efficiency, leverage, profitability and market performance, and providing insight into operational efficiency, financial stability and shareholder value. So starting with Padini, the current ratio increased from 4.38 to 4.51, indicating a strong capacity to meet short-term obligation. So the quick ratio decreased slightly from 3.31 to 3.06 due to higher inventory level, but remains above 1, showing that Padini maintains adequate liquidity to manage immediate liabilities. And next is efficiency. So looking at efficiency, inventory turnover declined from 4.25 to 3.06, suggesting slower stock movement, possibly due to expansion of stock accumulation. And total asset turnover also decreased from 1.05 to 0.94, reflecting slightly lower asset utilization as asset grew faster than sales. However, receivable turnover stay high at 29.62, showing effective credit collection. So for leverage and profitability, Padini's debt ratio rose modestly from 39.25% to 42.24%, and debt to equity from 0.73 0.65 to 0.73, supporting growth while remaining conservative. Profitability improved with net profit margin rising from 7.64% to 7.99%. ROA and ROE decreased slightly, but EPS increased from 14.85 to 15.68 cents, reflecting strong shareholder returns. And for Bonia, the current ratio fell from 3.92 to 2.82, and quick ratio slightly from 3.24 to 3.04, indicating some weakening of short-term liquidity due to increased inventory. Then for Bonia efficiency, inventory turnover decreased from 7.26 to 6.88, showing slower stock movement. And total asset turnover remains stable at around 0.51. However, receivable turnover declined sharply from 31.6 to 19.03, suggesting slower collection and potential liquidity pressure. For Bonia leverage and profitability, Bonia debt ratio increased slightly from 38.6% to 39.1%, while debt to equity remains stable at 0.63 and 0.64. So profitability was relatively stable with net profit margin at 11.42%, ROA slightly declining from 5.84% to 5.82%, and ROE improving marginally to 9.57%. EPS also showed slight growth from RM0.224 to RM0.229. And then to comparing both companies, Padini exhibits stronger liquidity, higher profitability, and better receivable management, making it more attractive to investors. Bonia performed better in inventory turnover, but slower receivable collection may affect cash flow. And both maintain moderate leverage, but Padini's slight increase support growth without increasing financial risk. So overall, Padini demonstrates superior trend performance, while Bonia needs operational improvement to enhance competitiveness.
Now let's compare Padini and Bonia. In terms of liquidity, Padini is stronger, meaning it can meet short-term obligation more easily. For efficiency, Padini collects receivable faster, while Bonia manages inventory better. Both companies are conservative in leverage, though Padini used slightly more debt. Profitability favors Padini with a higher return on equity. Finally, in market performance, Padini earning per share grow faster, while Bonia growth is lower. Overall, Padini appears more stable and investor-friendly, while Bonia needs to improve efficiency and cash collections.
So, in conclusion, Padini Holding Berhad is in a stronger financial position with healthier liquidity, efficient receivable management, and consistent shareholder returns. Bonia Corporation Berhad, while profitable, face operational challenge in cash collection and inventory management that could impact growth and liquidity. This comparative analysis highlights Padini's stronger positioning in the Malaysian fashion retail industry.